Hey, let me ask you something. Have you ever sat there with your phone in your hand, staring at that one old credit card you barely use anymore? Maybe it's the one you opened back in college, the plastic that's been in your wallet through 3 apartments, 2 jobs, and way too many late-night decisions. You're thinking, I should just close this thing. It feels clean. Responsible, even. Less temptation. No more random annual fee sneaking up on you. Fewer accounts to keep track of while life is already spinning fast enough. You picture yourself hitting cancel and breathing a little easier, like you just decluttered your financial closet. But here's the thing nobody tells you when that thought hits. That single decision, the one that feels like the smart, adult move, can quietly nudge your credit score down, not because you're irresponsible, not because you missed a payment, but because of 2 invisible forces most of us never learned about: the length of your credit history and something called credit utilization. And yeah, I've been there. I used to think the same way. Let's talk about why. Most of us grow up with this simple story about credit cards. They're dangerous. They lead to debt. So the fewer the better, right? Close the ones you don't need. Cut them up. Move on. It sounds logical. It feels like control in a world where money stress already keeps us up at night. Rent due, groceries up, family expecting you to have it together. We see the headlines: 5 ways to simplify your finances. Cancel these cards and save. And our brains go, yes, less is more. But the credit scoring system doesn't work on less is more. It works on a completely different set of rules. Rules that reward patience, history, and restraint in ways that feel counterintuitive. And when we close that card thinking we're fixing something, we can accidentally pull 2 levers that quietly hurt the very number lenders look at when deciding whether we get approved for a mortgage, a car loan, or even that apartment we really want. It's not your fault. Nobody sits you down in high school and explains that your credit score is basically a psychological profile built from decades of data. It's not judging your character, it's just math that tries to predict one thing: how likely are you to pay back what you borrow? And 2 of the biggest pieces of that math are the ones that get flipped upside down when you close an old card. Let me walk you through it, the way I wish someone had walked me through it years ago. First, there's credit utilization. This one is huge. It makes up about 30% of your FICO score, which is the one most lenders still use. Utilization is simply the percentage of your available credit that you're actually using right now. Picture this. Let's say you have 3 cards. One has a $10,000 limit, one $5,000, and that old college card has another $5,000. Total available credit, $20,000. Now suppose you're carrying a $4,000 balance across them, maybe from holiday travel, or fixing the car, or just life happening. Right now, your utilization is 20%. That's solid. Lenders like that. It says you're not maxed out, you have breathing room. But then you close the old $5,000 card. Poof! Your total available credit drops to $15,000. That same $5,000 balance? Now it's 27% utilization. Still not terrible, but if life gets a little tighter and you're carrying $6,000 instead, it jumps to 40%. Suddenly, the system sees you as using a much bigger slice of what's available to you. And here's the part that hits different when you're living it. That change happens instantly. The day the card closes, your total limit shrinks. Your balances don't. The math updates, and your score can feel it within weeks, sometimes even days. I remember talking to a friend who did exactly this. She had a card from 2012 she never used. Nice high limit, 0 balance. She was tired of logging into yet another account, so she closed it. 2 months later, she went to refinance her student loans, and her score had dropped 35 points. Not because she'd spent more, not because she missed anything, just because the available credit she used to have disappeared from the equation. She told me, "I felt like I was being punished for trying to be responsible." That's the trap. We close the card to feel responsible, and the system reads it as this person now has less room to handle unexpected stuff. The second piece is even sneakier: the length of your credit history. This is 15% of your score, and it looks at the average age of all your accounts. Lenders like to see that you've been managing credit for a long time without blowing it up. It's proof you've been around the block and still pay on time. That old college card? It's probably your longest-running relationship with any lender. Closing it doesn't erase the positive payment history right away. Closed accounts in good standing usually stay on your report for 7 to 10 years. But it does lower the average age of the accounts you still have open, and scoring models notice that. Think of it like a friendship timeline on your credit report. The longer the oldest friendships, the more trustworthy you look. Close the oldest one, and suddenly your friend group looks younger on average. The math shifts. I've seen it play out in real life more times than I can count. A guy I know, solid job, never missed a payment, closed his first ever card because the bank started charging a fee. His score dropped almost 50 points. He wasn't planning on buying a house anytime soon, so he figured whatever. Then 6 months later, his landlord decided to sell the building, and he needed to qualify for a new lease with a credit check. That lower score meant a bigger security deposit and a slightly higher interest rate on the new place. Not life-ruining, but annoying. Stressful. The kind of quiet financial friction that adds up. And here's where the psychology gets interesting. We hate complexity. Our brains are wired to crave simplicity, especially around money when we're already stressed about it. Closing a card feels like closing a tab on your mental browser. Fewer logins, fewer statements, less guilt when you see that unused card sitting there. It's the same reason we Marie Kondo our closets or unsubscribe from emails we never read. We want less noise, but the credit system is playing a longer game. It doesn't reward the clean desk. It rewards the person who's shown up consistently for years, even when they weren't using the tool. That old card sitting in your drawer, paid on time every month for a decade? That's quiet proof of reliability. Closing it removes some of that proof from the active equation. So the turning point, the moment that actually changed how I think about this stuff, is realizing that your credit score isn't a report card on how good you are with money. It's a snapshot of how the system sees your reliability as a borrower. And the system values two things above almost everything else in this context: low utilization and long, steady history. Keeping that old card open isn't about hoarding debt or being irresponsible. It's about understanding the game and playing it a little smarter. It's choosing long-term peace over short-term simplicity. Because when your score stays healthy, doors stay open. You sleep better knowing that if life throws a curveball, an emergency repair, a job change, a move, you've got more options instead of higher rates or flat-out denials. That awareness alone takes so much anxiety out of the equation. You stop second-guessing every financial move. You stop lying awake wondering if you're doing it right. You just understand the levers a little better. Now let's get practical. Because I'm not here to tell you never close a card. Life happens. Sometimes you have to. Maybe the annual fee is ridiculous and you're not getting value. Maybe the card was tied to an old relationship or a business that's closed. Or maybe you just want fewer things to manage. That's valid. The key is knowing how to do it without unnecessary damage. If you decide to close one, first look at which card is the oldest. Try to keep your longest-running accounts open if you can. If the card you want to close is a newer one, the hit to your average age will be smaller. Second, before you close anything, get your utilization as low as possible. Pay down balances. Ideally, get them under 10 to 20% of your total limits across all cards. That way, when one limit disappears, the percentage doesn't spike. And third, if the card has a high limit and you're carrying any balance elsewhere, consider keeping it open and just not using it, or call the issuer and ask if they'll downgrade it to a no-fee version instead of closing it entirely. A lot of banks will do that. And fourth, use the old card every few months. A small purchase, a tank of gas, a streaming subscription, then pay it off right away. This keeps the account active so the issuer doesn't close it for inactivity, and it keeps that positive history flowing. None of this has to be extreme. You're not becoming a credit card collector. You're just protecting the tools that protect your options. I've watched people do this the thoughtful way. One woman I know had 4 cards, including one from 2009. She was done with 2 of the newer ones that had high fees. She paid everything down, downgraded the oldest card instead of closing it, and kept the other 2 active with tiny monthly use. Her score actually went up over the next year because her utilization improved. She told me later, "I finally stopped feeling like the credit system was this mysterious enemy. It just became understandable." And that's really the quiet win here. Look, money stuff is emotional. It touches our sense of security, our pride, our ability to take care of the people we love. When rent is due and the car needs brakes and your kid needs new shoes, the last thing you want is another thing making life harder. Closing a card feels like taking action, but sometimes the smartest action is understanding why the system works the way it does and working with it instead of against it. You don't have to have a perfect credit file. You don't have to memorize every formula. You just have to know the 2 things that actually move the needle when it comes to closing accounts: utilization and history. Keep those in mind, and the anxiety starts to loosen its grip. So the next time you're staring at that old card in your wallet, wondering if you should close it, pause for a second. Ask yourself, is this about simplifying my life, or is it about protecting the options I might need down the road? Sometimes the answer is close it. Sometimes the answer is keep it open, use it once in a while, and let time keep working for you. Either way, you're not failing. You're just becoming someone who understands the game a little better. And that understanding, that's worth more than any score on a screen. You've already made it this far in the video, which tells me you care about getting this right. Not for some flashy millionaire mindset, but for real life, for calmer nights, for fewer surprises, for the version of you who's building something steady, one informed decision at a time. That's enough. That's more than enough. Thanks for hanging out with me today. If this helped even a little, drop a comment with your own experience. I read every single one. And if you're carrying that quiet money stress right now, just know you're not alone in it. We're all figuring it out together. Take care of yourself. I'll see you in the next one.